Welcome back, traders and investors. We have Mark Shepard on the line, founder and president of Derivative Strategy Consultants. He provides derivative option solutions for institutional clients, family offices, and RIAs who realize the need for more active and professionally managed risk. So you actually think there's risk in this market, Mark?
As of this morning, apparently, yes, there is.
Okay, so tell us about your firm a little bit.
Yeah, well, I've been running derivative strategy consultants for the better part of 3 years now, and what I've found is that optionality and the use of standardized derivatives in portfolio management is such a great tool for institutional investors to use. However, in a lot of spaces, in a lot of boardrooms and offices, these folks don't have a risk mitigation professional helping them use these contracts. So DSC was formed to work with and internalize the strategy and outsource solutions for these institutions. So it can be used as a derivative overlay strategy. It can be used. Strategy can be used around calendar, threshold, and opportunistic trading ideas. So every client solution is a little bit different, but it's based on communication, and it's really working with and listening to the client's needs and adding optionality to the portfolios as necessary.
But it hasn't like managing risk and hedging, hasn't that been like a dirty word, over the last couple years, that you're just hurting your overall returns in your portfolio?
I think derivatives in general have been a dirty word, unfortunately, as I provide education to boards around optionality. A lot of people just don't understand the benefits of these contracts. But straight to your points, a lot of the institutions that I work with had drawdowns of upwards of 30% during the last crisis. Now, there's not another pension in this country that can afford to have that type of drawdown again. And as you well know, as the listeners know, there's an extreme pension crisis in our country, especially here in Illinois. So that's why I think derivatives and hedging and having a risk mitigation professional working with the team is becoming the norm and not the exception.
Okay, so when you're talking about optionality here, you're going beyond your traditional listed options, correct? That are on the markets. Are you talking about more exotic products that are kind of packaged up by some of the investment firms? Is that what you're referring to with optionality? Or are you talking strictly about everything that's provided in the in the regular markets?
Sure. That's a great question. You have to realize that the most of the clients that I work with are running a 60-40 equity to bond portfolio. So there needs to be complementary options that can be used within the portfolio from a strategy and risk mitigation perspective. So anything that I would use with those types of clients are all on board with exchange traded derivatives. Whether we have such great exchanges here in the U.S. Whether you're talking the CBOE, the CME, the ICE, there are just so many great products out there. So I really don't have to go and search for the exotic solutions, if you will.
Right, and there's also more risk, associated with the off-exchange products. So a lot of your strategies for hedging and managing portfolio, taking the volatility into account, is you're keeping an eye on interest rate and tail risk solutions, to name a few. Now, the Fed. Supposedly, the sell-off here is because of the Fed statements that they're going to, ramp up the end of, the end of QE and the tapering and stuff. What's your outlook for interest rates?
Well, interest rates could go obviously either way, and that's the conundrum right now. If we think there's a lot of growth, then I could certainly see the 10-year going to say 2.93%. But when you're dealing with geopolitics and perchance some sort of bank trouble in Portugal, maybe Spain later on, then the 10 year is going to be a place of safety. So we could be seeing a 2.4 on the 10 year, but that's because no one knows where the interest rate is going to go. That's why optionality can be used to help mitigate that risk in that portfolio. But one of the things I have written about and talked about in the past is with all this Fed accommodation, then what happens if there is a tail risk scenario in the 10 year in our interest rate markets? What happens one day if we wake up and the 10 year is 4.5%? What would that do for our market? And could that be the next asset class to see that type of trouble? And I think there are some possibilities with that scenario, given what's going on in China and even the euro. But we've seen with past crises, the Fed is ready to step in and the ECB is ready to step in. But is that just fueling the fire a bit more? So we great question. We don't know, but that's why DSC works on a daily basis with clients to discuss those risks, to look at their portfolios, and to adjust using optionality or futures options accordingly.
Okay. All right. So, you do the work for the big boys here, institutional clients, RIAs or whatever. Great run in the market here over the last few years. What's your advice for the little guy here? I mean, they obviously, someone with different size portfolios don't really take advantage of hedging tactics. And someone like your firm, you're probably looking for institutional and big money clients. What are your suggestions for the average investor to protect their profits?
Sure, that's a great question. I would think, irregardless of whether you're an institutional client or a mom and pop saving for retirement, if the smaller investor is not going to use derivatives for hedging, I would certainly suggest taking some money off the table and having those discussions with your financial advisor about reallocating to different asset classes, just to make sure those portfolios are acting in accordance with their overall wealth needs.
Okay, great advice. We've had Mark Shepard here on the line. He's founder and president of Derivative Strategy Consultants. Mark, that's the opening bell there. We'll let you go, and thanks for your insight. We hope to have you on again.
Hey, I appreciate your time. Thanks a lot, and good luck to everybody out there today.
Okay.